In this example video, we're going to go over review exercise 5.7, where again, we're going to be talking about discontinued operations, but in this case, we're given the pre-tax values, and we're going to calculate how we come up with our earnings per share based on what we have for continuing operating income and our net income. So they tell us that our corporation reported the following pre-tax information for its current fiscal year. So we had $40,000 in income from continuing operations, an $8,000 loss arising from discontinuing a segment. It was simply closed and there was no gain or loss in the sale, so we didn't sell it off to anyone else. And they are subject to a 30% income tax rate, and they had 8,000 shares of common stock outstanding for the year. So again, they want us to start with the pre-tax income from continuing operations and then do our lower portion of our income statement. So we have our pre-tax income from continuing operations, and they told us our pre-tax income was $40,000. We're going to tax that, so we have our income tax expense, and we're going to do our $40,000, which is our pre-tax income, times that 30% tax bracket that we have. So we have $12,000 in taxes that we'd have to pay based on our income from that continuing operations that we have. So our income from continuing operations, we sum the two to get $28,000. Now we have our results from discontinuing operations, and because there's only one item that we're looking at, we can just list it out. So we have a loss from our discontinued operations, and I have to net it of tax. So they told us our loss was $8,000, and we'd have to tax that at 30%. So basically we're getting a tax break. We don't have to take the full $8,000 loss. We're going to reduce that by 30%. So 8,000 times 30% is $2,400. So we have net of a $2,400 in income taxes that we have. And again, the $2,400, we're taking the $8,000 loss times the 30% income tax rate that this company is subject to. So that means the $8,000 loss minus the $2,400 in income tax credit that we have. We only have to reduce our overall income by $5,600 rather than that $8,000. So again, we sum it up to get to our net income, and our net income for this business is going to be at $22,400. So we know that we have to do our earnings per share, and we do that for net income, but now net income is made up of two separate components. It's made up of our income from continuing operations, and it has a portion of this loss that we have that's not going to be carrying forward with us into the next year. So we want to show that breakout in our earnings per share calculation, just like we do on our income statement. So we have our income from continuing operations. And our income from continuing operations right here is at $28,000. And we're going to divide it by the 8,000 shares of common stock that we have. So our income from continuing operations is at $3.50. Again, if we are a potential investor and we're looking at a company's income statement that has discontinued operations, we are really going to want to focus in on this line item for earnings per share, because this is what's going to be carrying forward with us into the next future years, because this is going to be what is continuing with the business versus what is not continuing. So we have our loss from discontinued operations, and our loss because of something that we're no longer going to have going forward is at $5,600, and we divide it by those 8,000 shares. So we're seeing a drop in EPS by 70 cents because of this discontinued item. So again, next year, that's negative 70 cents isn't going to be there because we got rid of this operation segment of our business that maybe wasn't operating as well as we had hoped. So net income on an earning per share basis for this year is $2.80.